Welcome to the Opening Bell Report.
I have this general rule of thumb when I look at the market.
Okay.
Small companies are like speedboats. They can turn on a dime, double in a day, but, they can also capsize if a big wave hits.
Right. And large companies.
They're the ocean liners. They're stable, they're safe, but they are painfully slow. I mean, it takes them 5 miles just to make a left turn.
That is the conventional wisdom. Absolutely. Low volatility, steady returns.
Right. So explain to me what on earth happened yesterday, because I was looking at my screen. I was looking at Novo Nordisk, ticker NVO, and that is definitely an ocean liner.
It's a huge pharmaceutical giant.
And it moved like a penny stock.
It was startling.
It was up 9.12%,
right,
in a single session. For a company of that size, that isn't just a good day. That's a geological event. It's like watching a mountain suddenly decide to sprint.
It definitely woke everyone up, closing at $62.33. But to be honest, if you just focus on that big green candle on the chart, you're missing the real story.
How so?
The price move is just the smoke. We need to look at the fire.
And that is exactly why we have this analysis report in front of us today, because frankly, when I see a move that violent from a company this size, my first instinct isn't buy.
No, it's
glitch or short squeeze. It feels artificial. But this report, it suggests something much more fundamental is going on.
It's definitely not artificial. What we're seeing is a repricing. A violent repricing, yes, but a rational one. The analysis argues that for the last, 6 months or so, the market has just been looking at Novo Nordisk all wrong.
The wrong lens.
Yeah, they've been pricing it like a company in decline, or at least one whose best days are over. But there's a metric buried in this report, a single number, that suggests this company is operating at a level of efficiency that is, it's frankly absurd.
Okay, absurd good or absurd bad?
Absurdly good. I mean, it's a number that just calls into question why the stock was ever trading this low in the first place.
And the report frames this moment. We're in early 2026, right as earnings season kicks off.
It positions this as potentially the golden buying opportunity of 2026.
Okay, you have my attention, but I am holding on to my skepticism.
Yeah.
What is this magic number?
It's the ROE, return on equity.
ROE, okay. I feel like this is one of those terms that gets thrown around all the time and everyone just nods like they get it. Let's actually strip it down. Why is this the anchor for a strong buy thesis?
Think of it as the ultimate measure of how good management is. If you, the shareholder, give the company money, that's the equity.
Right.
ROE tells you how much profit they're generating from that specific pile of money. It's the engine's efficiency rating.
So if I give a company $1, how much are they giving me back in profit?
For the average company in the sector, maybe 15 cents. If they're really, really good, maybe 20 cents. A 20% ROE is usually considered excellent in big pharma.
Okay, so 15 to 20 is the benchmark for an A-grade performance. So where is Novo Nordisk on that scale?
70%.
Wait.
Nearly 70%.
Hold on. 70. For every single dollar of equity, they are generating 70 cents of profit.
That doesn't sound right. That sounds like a typo. Or it sounds like a tech startup with one employee and a laptop.
Right.
How does a massive capital-intensive company like Novo Nordisk hit 70% ROE? Is this some kind of accounting trickery?
It's a totally fair question, and usually I'd be just as skeptical. But this isn't a one-time tax credit or them selling off a factory to juice the numbers. This is operational.
Okay.
It comes down to the sheer dominance of their product line, specifically, the GLP-1 weight loss drugs like Wegovy.
So they just have such insane pricing power and such high demand that their margins are exploding?
Essentially, yes. They have what the report calls a profitability monster on their hands. They're making a product the world is desperate for, and they've scaled it so efficiently that their costs are relatively low compared to the revenue. It creates this massive spread.
Okay, so they are printing money. They're 3 to 4 times more efficient than their competitors.
But here's where I get stuck. And this is the paradox, right? If a company is generating 70% ROE, Wall Street usually knows about it. And when Wall Street knows, they bid the stock price up to the moon.
Oh yeah, you're paying a huge premium.
You usually have to pay a massive premium to own a company that efficient.
You typically pay 50, 60, maybe 70 times the earnings for a company like that.
Right. High quality costs a lot. But looking at this report, the PE ratio, the price to earnings, is sitting at 17.
17.19 to be exact.
That makes no sense at all. A PE of 17 is? That's a utility company. That's a boring bank that grows 2% a year.
Exactly.
That is not a 70% ROE monster.
And that mismatch is the entire basis for this deep dive.
Yeah.
That is the inefficiency the analysis is pointing to. You have the performance of a high-growth tech darling.
But the valuation of a clearance rack value stock. So, okay, play devil's advocate. Why? The market isn't stupid. Usually if something's cheap, it's cheap for a reason. Is it a value trap? Is the market expecting that 70% ROE to just collapse?
That is exactly what the market was thinking. You have to rewind to late 2025. What was the narrative everywhere?
It was the GLP-1 slowdown, right? All the headlines were saying the boom was over.
It was constant.
Talk about cheaper pills coming out, competition from China, supply chain issues.
Fear. It was a wall of worry. Investors convinced themselves the easy money was made and that Novo Nordisk was about to hit a cliff. So they priced the stock as if growth was going to zero.
And that's how you get a PE of 17 on a company this good.
Precisely. The stock price was reflecting a disaster scenario.
That hadn't actually happened yet.
Right. And that brings us to yesterday, the catalyst.
The wake-up call.
The report details why the stock just exploded. It wasn't random buying. It was the realization that the slowdown narrative was objectively wrong.
Wrong how?
The data came out on Wegovy demand. It's not slowing down.
It's not.
It's accelerating.
Accelerating after all this time.
The market saturation everyone is so scared of, it's just not there. We're nowhere near the ceiling. In fact, the report points to a massive new revenue driver that the bears completely ignored.
Which is?
New approvals for higher doses in key markets.
Which markets?
Specifically, the United Kingdom.
Okay, now that's significant. You open up the UK for higher doses. That's not a little bump. That's big institutional healthcare money.
It creates a tangible, verifiable revenue stream that just wasn't priced in. So you have investors sitting there shorting the stock or avoiding it because they think the party's over.
And then data drops showing the party's actually getting bigger.
And everyone has to rush through the same tiny door at the same time to buy back in.
Which explains the 9% gap up.
Hence, the violent repricing. The market realized it was holding a winning lottery ticket that it had been treating like a used napkin.
It's funny you mentioned the rush through the door, because I want to look at the technicals now. The report uses some very specific language about the chart action yesterday. It calls it a breakaway gap.
Yes. And this is really important for anyone who watches the charts.
I'm not a technical analyst, but breakaway sounds aggressive, like a jailbreak.
That's actually a great analogy. Think of $60 a share as the prison wall. For months, NVO has been stuck below 60.
Right. It bumps its head and pulls back.
Bumps against it, pulls back. It's resistance. The ceiling.
Correct.
A normal breakout would be the stock trading up to like $60.10. A breakaway gap means it didn't even bother. It closed one day below 60 and opened the next morning way above it. It jumped the wall entirely.
It teleported over it.
Effectively, yeah. And when you leave a gap like that on a chart, especially clearing a huge psychological level like $60, it signals a shift in regime. The bears who are defending that $60 line, they've been totally overrun.
So $60 was the ceiling. Does it flip now and become the floor?
The report argues that 60 is absolutely the new floor, the new psychological support. As long as the stock stays above 60, the bulls are in total control.
Okay, so we're standing on the second floor now. We're at 62.33. Where's the next ceiling? The next wall?
The analysis points to $63.30.
That's pretty close. We're almost there already. What's special about that number?
That's the 200-day moving average.
The big one.
For institutional investors, the 200-day is the dividing line. It's the bull market versus the bear market. If the stock is below it, the trend is down. If you break above it, the trend is up.
So if NVO can punch through 63.30?
The report says there's a clear runway back to the $70 range. There's very little technical resistance between 63 and 70.
Wow, that is a lot of open air. But I want to go back to the rush you mentioned, the violent repricing. How do we know this isn't just retail traders on Reddit getting excited? How do we know it isn't just hype?
Volume.
Volume never lies.
Never. Look at the numbers in the report. Yesterday, 42 million shares changed hands.
42 million.
That is enormous. You and I and the folks listening, we don't move 42 million shares.
No.
We just don't have that kind of firepower. When you see a gap up on that kind of volume, it means the institutions are involved, the whales.
The pension funds, the hedge funds?
Exactly. They are the ones buying this dip. And they don't day trade. When they buy 42 million shares, they're not looking to sell them tomorrow for a nickel. They are building positions for the next year.
So the smart money is stepping in. They see the 70% ROE, they see the PE of 17, and they're just saying, thank you very much, we'll take that.
They are feasting on the market's mistake.
It really does sound like a perfect storm for a long setup.
Yeah.
But let me be the skeptic one last time. Let's say I buy in, but the market stays irrational. Maybe it doesn't run to 70 right away. Maybe it just chops around for 6 months. What happens then?
That is where the wide moat and the dividend come in.
The wide moat. I love that Buffett term.
It's so crucial here. Novo Nordisk isn't some tech company that can be disrupted by two people in a garage next week.
Yo.
You've got regulatory approvals, manufacturing scale, patents. These are huge barriers to entry. That moat protects that 70% ROE. But while you wait for the stock price to catch up to that value, you're getting paid.
The dividend.
The report highlights a dividend yield of 2.77%.
Which, in this market, is not nothing.
It's nearly 3%. It's what we call being paid to wait. Even if the stock goes sideways for 3 months, you're still collecting a better yield than a savings account on an asset that has this massive upside potential.
It definitely lowers the blood pressure a bit. You aren't just relying on the price going up.
And heading into the 2026 earnings season, having that income cushion makes it a lot easier to hold through any volatility.
So let's try to pull all of these threads together. We've covered a lot, from accounting metrics to chart patterns. If you had to summarize the strong buy thesis from this report, what's the pitch?
It's a three-legged stool. If any one of these legs was missing, the whole thing would be weaker. But they're all there.
Okay, leg one?
Elite efficiency. That's 70% ROE. The internal engine of the company is just a cash-generating machine at a rate that's statistically rare.
Leg two.
Value pricing. The PE of 17. You are getting that Ferrari engine for the price of a Toyota. The market completely mispriced the asset because of a fear that's now been proven false.
And leg three.
Technical confirmation. That breakaway gap on institutional volume. The chart itself is screaming that the sentiment has shifted, and the big money is backing that shift.
It's a really compelling combination, but I still can't shake the psychological part of this. We're here in 2026. This company's been a monster for years. Why does the market get it so wrong so often?
Humans.
Humans.
Algorithms run the trading, sure.
Yeah.
But humans program the algorithms. And humans are emotional. We overreact to fear. When the headlines in 2025 screamed, GLP-1s are dead, people panicked.
They didn't look at the numbers.
They didn't look at the ROE. They didn't look at the PE. They just hit sell.
And that panic created the opportunity we're looking at today.
Inefficiency is almost always born from emotion. The math. The numbers were always there. That 70% ROE didn't just appear yesterday. It was there last week, last month.
But the market just refused to see it.
Until the price action forced them to look.
It's a great reminder that price and value are two very different things.
They rarely are. And your job as an investor is to spot when they diverge.
So for you listening and staring at your portfolio today, the question isn't just about Novo Nordisk. It's about how many other monsters are out there hiding in plain sight.
Disguised as boring old value stocks.
Exactly. How many other companies are generating 70 cents on the dollar but are trading like utilities because of some temporary narrative, some temporary fear?
That's the hunt.
Yeah.
But right now, NVO is the one standing in the spotlight.
Well, the giant is definitely awake now. Whether it sprints to 70 or, takes a breather at 63, it is going to be fascinating to watch.
Just keep an eye on that $60 level. As long as that holds, the story has fundamentally changed.
We will be watching. Thanks for unpacking this with us. It's always fun when the numbers tell a story this clearly.
My pleasure.
And to our listeners, go check your watch lists. See if you can spot the next sleeping giant.
Don't forget to like, share, and subscribe for more.